Oh, it certainly surprises me, Tyler. I'd have to think they're talking about DIY, do-it-yourself investors, perhaps day traders. But we find at Oppenheimer, our investors generally are their portfolios are designed in context of their risks, risk tolerance, their objectives and goals, and are way under 100% of their portfolio in equities, but are diversified according to their needs and objectives. We'd have to think this, I think much like Bob said, in this particular point in time, with interest rates as low as they are, if you can get 2% and achieve that on an annual basis over the years, the lucky thing is you'll double your money in 36 years. On the other hand, if you can get 6% on average over the years, you can double your money in approximately 12 years. And the average return, price return of the S&P 500 since the end of 1997 up until last weekend, including the tech bubble, the housing bubble, all that kind of stuff, the financial crisis, average return of the S&P 500 based on FactSet numbers is 6%. And that's before dividends are considered. So we'd have to think that stocks are important. It's important for investors to consider their goals and objectives. And we would suggest a professional, experienced advisor to help them make their decisions.
You know, Bob, I'm curious here. I'm more heavily invested in equities, perhaps, than the models would suggest I should be, given my age. But I do think that the return, I think you'd never go wrong when you bet on America, and that's kind of my thinking there. But I'm curious, if you look at fund flows, as I know you do, into ETFs and mutual funds, it's been heavily into fixed income for not just a little while.
Yeah, I think that is certainly there. I think the problem is people are very concerned about the future, and that what they see is a lot of uncertainty. So the trend is to put more money into bonds. But don't kid yourself. There's still a lot of money in stocks, much more than Fidelity thinks people should have. The bottom line is this, Tyler. It makes perfect sense. People are momentum investors. Stocks have outperformed bonds for dramatically in 10 years. Why shouldn't people put more money in stocks than bonds? But remember the age thing. Remember that old rule, invest in bonds what your age is? 60 years old, you should have 60% in bonds. That's crazy if you're going to live to 85 or 90 years old, as most baby boomers are going to do that. The numbers are all wrong, and it's Fidelity and Vanguard should go back to the drawing board and start redoing these recommendations. That's my opinion.